Hello guys, my name is Mubashir Ansari and today we are going to analyze the Shakti Pumps. I was thinking to analyze, let's start with the technicals of this stock. I mean where it is trading and how far it can go. I mean how much it is discounted from it is to all time high, okay. So I think it will be a best idea to watch the weekly chart. Looks like, look at that from 93 to the all-time high 1300, around 17 or 100% return, around 70 times. If you have invested in this stock around 1.5 year ago, 1.5 year ago, you will be already made at 17x from this stock alone. That's a huge return for this stock. As we can see that now it is at a support level of 813 and it is discounted from it is all time high of 41%. That's a great news for us, and the next support will be around 677. Okay, so basically currently stock is trading at it is we can say lowest point of the of it is if we compare with the his all time high. So let's start with the it is fundamentals. As we market cap is one. Let's start with the about the company. Shakti Pumps Limited is a primary engaged in the manufacturing of the pumps and motors of various kinds. As the name indicates, it is related to the pumps. So basically, the manufacture the pumps and it is related instruments, and that helps in the irrigation, horticulture, domestic water supply, commercial, and industrial applications. Pumps are always meant to be the domestic one. Okay. Products offering, basically they offer pumps, motors, controllers, others. Okay, EV segments also. Basically they have EV section too. The company incorporated Shakti Mobility as a was in December 2021 to manufacture EV motors. Okay, basically they are now in a EV sector too, which is too different from their primary sectors. Okay, charging stations, battery management system, electric control panels, smart electric control panels, CFDs, etc. The company has committed to invest as 114 crores in Shakti EV Mobility over 5 years. Means they are starting doing capex in their EV segment. Okay, customer base government projects is placed on 69% of their revenue. We can say that they are quite concentrated towards the government projects. Okay, and 21% is from the exports. Okay, and exports are mainly happening in Asia, Africa, and Middle East. Okay, so basically company is manufacturing the pumps and pump related instruments, and now they are in EV motors. So it is a mid cap, we can say mid cap, or we can say the nearly a small cap company. So the stock is trading at a 24.3 and the industry pays 43. That shows that they are quite at a lower valuation. If we let's see the PEG ratio, then we can decide. So basically PEG ratio is 0.3 around. So basically company having a too much good growth, as the EPS is growing at a better rate. That's why the P is also low and the PEG ratio is also low. That shows that the company is quite undervalued. Return on capital employed is 55.3 and return on equity 42.6. That shows the company has a low debt level. As we can see, the debt to equity is 0.14. Interest coverage ratio is quite high. That's good. EPS growth for the 5 years is 95%. That's why their PEG ratio is quite low. Quick ratio is 1.8 and the current ratio is 2.2. That shows that company have inventory in their stocks, which is not that much bad because they are having a quick ratio of around 2. That shows that company has a good liquidity. Book value is 96 and the current market value is 80. So company having a price to book value ratio of around 8. Price to book value 8. Okay, that's quite. We can see industry price to book value is 7.5, which shows that the company's current market price to book value is a little bit higher. Maybe because market is pricing the stock at their premium, because the company is doing a good, making a good money. As we can see, the APS for the 5 years is 95.6%. That's huge. And changing promoter holding is quite bad, as we can see that there is a within 3 years the promoter holding reduced by the 4.55%, which is not a good sign for the company. Sales growth for the 5 years is 45.7. That's excellent. APS for the growth for the 10 years is also excellent, around 30%. Average dividend payout for the 3 years, I think their company is doing too much capex that so they don't have to pay the dividend, but they are still paying the dividend around 8% of their total earnings. That's great for the company, but I think if they don't pay the dividend, there is no bad thing for the company. Okay. EV to EBITDA is around 16. That we can accept that because the company is showing a good growth. Let's see the history P along with the EPS. In 2018, starting the company was having a 28 P with the EPS of the 3.3. Okay, now company having a 27 P with the EPS of the 33 point around 34. There is a huge difference. Companies we can say that trading at a very lowest price. Let's compare with its peers. Quarterly sales variance is from average it is low. Tag ratio is quite too much low, but which is great for the company. EPS for the 12 months is also around average. Sales variance for the 5 years is above average, too much we can say. Profit variance for the 5 years is also great. Interest coverage ratio is acceptable. We cannot say it is low. Current market price to the book value it is above average. EV to EBITDA is below the average. Current market price to the sales means for the each sales how much for each rupee of sales investor price ready to pay 3.91 times. Return on equity is more than average, above average. Return on capital employed also great. There is no price debt equity ratio is also great. Is more than below, too much we can say below the average, industry average. Let's see the quarterly results. Year on we can see that the year on year growth is quite high. Now within those March and June quarter they have performed not well, but still companies done very good. Within these 3 years we can see that from 250 to 622 means they have nearly made 2.5 times of the increased their sale by the 2.5 times within 3 years. And there, let's see there they are utilizing their cost efficiently or not. Material costs have been reducing over the years. That shows that they might be increasing their margin. Yeah, right. Operating profit margin have been increasing over the years from 8% to the 25%. On an average, we can say that this is very good for the company. Interest obligation remains very stagnant. So, and from the profit of 9 crore to 97, 10x increase because of the increase in the margin and also the increase in the revenue. That's a huge improvement for the company. Let's see the profit and loss account. The sales growth for the company is increasing over the years. That's a very good sign for the company from 300 to 25. That is around 8 times. That's very good for the company. Operating and their expenses. Material they have company is not efficiently able to reduce the material expenses. As we can see that the material expenses has been increasing over the years. Raw material expenses has increased quite a lot. Employee cost has reduced here. We can see that other cost has been also reduced, but the raw material cost remains the major problem for the company. Operating profit margin is, but still company is able to improve their margin from 15% to 24%. Interest obligation remains stagnant if we compare with the profit. The net profit is quite too much increase over the years. That's very good sign from 25 to 400, around 20 times, 18 times. Let's see the balance sheet of the company. Equity capital, as we observe that the company has sold their stocks, so basically their equity capital has increased from the 15 to 120, and reserve also increasing over there because they have sold their shares and they are making good profit over the years. Their long-term borrowings is we can say there is very less long-term borrowings. They are basically having a short-term borrowings. That's a very good sign for the company. Trade tables have been increasing over there. That's a bad sign for the company. They have to pay because long-term tables, if they are not paying the creditors, that's a very bad sign because it will increase their burden. It will increase the burden towards the company, right? Fixed assets, we can see that company is increasing their buildings and the plant and machinery over the years, equipments, computers, furnitures and vehicles. Intangible, they don't have any intangible assets, means they don't have any patents and rights. Investment, company is not doing any investment, looks like. So current work in progress, look like they have done capex here, which is currently work in progress. Inventory, company is currently increasing over there because they are increasing their sales, so basically they are now making more inventories and putting them in a stock. That's not bad sign because they have to do that so that they don't run out from the inventory, right? Receivable over the 6 months is quite initially low. Now it is been increased because they have increased their sale. Receivable under the 6 months is quite acceptable because it is under 6 months. They are not doing any provision for the doubtful debt. That's the bad sign for the company. Cash and cash equivalent is increasing. That's good. Now let's compare with the cash flow. They have made a profit of let's say the what cash flow shows, that the cash flow shows that the 40, 50, that's 90, and 110. They have received 110 crore within 3 years, and what profit and loss statement shows that 110, right? So basically 160 and 400, 560, and if we include the depreciation and tax, so basically it will be around 700. So basically company is not efficiently able to collect the cash. That's they are mainly selling their pumps and all their products in credit. That's a very bad sign for the company because they are not able to collect the cash. They are just showing the profit, but they are actually not collecting the cash. That's a very bad sign for the company, right? Receivables, we can see that the receivables have been increasing over the years, but here they have collected too much cash, so we can observe that. Inventory is reducing. That's good sign for the company. Payable is also reducing. We can see that. That's also good sign. Direct taxes, cash. Now let's see from where the company is investing and what they are selling. Fixed asset purchase, as we can say that they are continuously buying the fixed assets. Fixed assets, so they are not selling any fixed assets. Currently work in progress, capital work in progress. As we saw that there is a capital work in progress of 37 crores. There is no acquisition happening. Let's see from where the company is getting cash. Proceed from this, as we observed that they have sold their stock. So it is collected from there, and repayment of borrowings. So the companies have continuously repaying their borrowings, which they basically having a short-term borrowing, long-term borrowing. They have less long-term borrowing, right? They are continuously paying their interest obligation. They are also paying the dividends. So basically, cash flow statement shows that the company is quite selling the products on credit, not collecting the cash. That's a very bad sign for the company. We have to continuously watch the company. Debtor days. Debtor days is also increasing over the years. Inventory days also look like the inventory days is slightly reduced over the years. Means the company has increased their efficiency. They are now able to generate more sales. Days payable is also increasing, and cash conversion cycle remains in positive and even in 120 days. Means that net working capital is tied up in the business for 120 days. Basically, net working cash conversion cycle shows that how many days the net working capital is tied up in the business. The formula is net working capital, that is current assets minus current liability divided by the sales into the 365. It is bad if the company is not able to improve because they have to invest their own money before paying the debtors, right? Working capital days is remain in positive. That's also bad. Let's see what promoters are thinking. As we can see that promoter remains same, but suddenly they have sold their stake in the company, and now they have recently sold more, which is bad, which is a bad sign for the company. FIIs, but the FIIs increasing their stake in the company, that's good, and EIs also increasing their stake in the company, that's also good for the company, and public losing interest towards the company. And we don't watch, I personally don't watch the public because I mainly concern about the FIIs and AIs and the promoters, but promoters showing the negative sign, but the FIIs and AIs is showing the positive sign. Recent major announcement, let's see. Basically, company just paneled 24/7/20 solar pumps and 10,000 units change booked for the 268 crores around. Let's see the result, if there are any recent resignation happening. No, there is no recent resignation happening in the company. So overall, company is doing quite excellent. We can say excellent. Company is doing excellent, but they are doing excellent sales. So and even they are entered in the EV segment, which is good because they are now diversifying their portfolio. But company is quite concentrated because as we observe that the company's major sales goes towards the government, that is 69%. Here we can see that major sales they are doing in the government, that is 69%, which is bad sign for the company. Also, they are doing sales, but they are not able to collect the cash. As we observe that in cash flow statement, they are not able to collect the cash. They have basically generated around 700 profit, but they are hardly able to collect the 110 crores. That's very bad sign for the company. Also, there is a cash conversion cycle is too much high. So if you want to invest, you better need to watch this stock over the years, because if they are not able to improve this, it will be a very bad sign, and we can say the red flag. It will lead to the we can say the slowdown for the company, or we can say the bankruptcy, because if they are not able to collect the cash and they are just doing the capex. Currently they are not having that much debt, but still it is too much concerning because they are not collecting the cash. So, and also I have done the DCF, that is discounted cash flow model on this company, and it comes out to that company is called trading at a premium, and it is better that if we invest in this stock, if it is reaches the level of 680, right? So if you want to invest in this stock, you better go for the 680. And or you can that rupee cost averaging. You can do rupee cost averaging, slightly invest here, then start invest here, and then start invest here, right? So overall, for the my view for the company is that we should just put this stock in the overwatch list, and if the stock crashes and goes towards the level of 680, then we can buy some. And then we have to analyze the stock, not stock, we can say that cash flow of the company, that they are able to generate collect the cash or not. If they are not able to collect the cash, then we have to avoid this stock overall. And first of all, I am not a SEBI registered research analyst, as you can observe that with my analysis. Thank you so much for watching. Have a nice day.